Why bigger dollars mean bigger taxes. Money is power, they say, but the more money you earn, the more taxes you pay. Have you ever wondered why this happens? It's not just about numbers, it's about how the tax system is designed to work. Earning more isn't just a sign of success, it also comes with bigger responsibilities, and taxes are at the top of that list. In this article, we'll explore why bigger dollars lead to bigger taxes, how the tax system works, and how you can plan smarter to keep more of your hard-earned money. Let's break it all down in a simple, relatable way. 1. What is progressive taxation? Most tax systems around the world, including in the United States, use something called progressive taxation. This means that the more money you earn, the higher the percentage of your income you pay in taxes. For example, if you make $40,000, your tax rate might be 12%. But if you make $400,000, your tax rate could climb to 37%. The logic here is that people earning more have a greater ability to contribute to public resources like education, healthcare, and infrastructure. At first glance, this may seem unfair. Why should someone who worked hard to earn more have to give up a larger share of their income? The idea is that basic necessities, like food, housing, and transportation, take up a bigger chunk of a low earner's income than a high earner's. So, higher earners are expected to contribute more while still having plenty left over. 2. How tax brackets work. One of the biggest misconceptions about taxes is that earning more will make your entire income subject to a higher tax rate. That's not how it works. Taxes are divided into brackets. Only the income within each bracket is taxed at the corresponding rate. For example, the first $10,000 of your income might be taxed at 10%. The next $30,000 might be taxed at 15%. Anything above it might be taxed at 20%. So, if you get a raise that pushes you into a higher bracket, only the dollars in that bracket are taxed at the higher rate, not your entire income. This system ensures that everyone benefits from the lower rates applied to the first chunks of their income. 3. Why bigger dollars mean bigger taxes. As your income grows, more of your money moves into the higher tax brackets. That means the additional dollars you earn are taxed at higher rates. Let's say you make $80,000 a year, and the tax rate for income above $50,000 is 22%. Only the $30,000 above $50,000 is taxed at 22%, while the rest is taxed at lower rates. If you get a raise to $100,000, that extra $20,000 will now fall into a higher tax bracket and be taxed at an even higher rate, like 24%. This is why earning more can feel like you're not taking home as much as you expected. The tax rate increases with every new dollar you make. 4. Capital gains and investment income. Earning bigger dollars isn't just about salaries, it's also about investment income. When you sell stocks, real estate, or other assets at a profit, the money you make is called a capital gain. Capital gains are often taxed at lower rates than regular income, especially if you've held the investment for more than a year. For example, short-term gains, investments held for less than a year, might be taxed like regular income. Long-term gains might be taxed at 15% or 20%, which is lower than the top income tax rate of 37%. This lower tax rate benefits wealthy individuals who earn a large portion of their income through investments. It's one reason why critics argue that the tax system favors the rich. 5. Deductions and credits, your best friend. Taxes aren't just about what you owe, they're also about what you can save. Tax deductions and credits are tools that help reduce your tax bill. Deductions lower your taxable income. For example, contributions to retirement accounts or interest on student loans can reduce how much of your income is taxed. Credits directly reduce the amount of taxes you owe. For example, the child tax credit or education credits can lower your tax bill dollar for dollar. High earners often have access to more deductions, like those for charitable donations or mortgage interest. However, as your income grows, some deductions and credits may phase out, leaving you with a high. 6. Hidden costs of higher earnings. Higher income doesn't just mean bigger taxes, it can also affect other areas of your financial life. For instance, you might lose access to income-based tax credits. Student loan payments tied to your income may increase. Medicare premiums might rise as your income crosses certain thresholds. These hidden costs can make a pay raise feel smaller than it actually is. That's why it's important to plan for the financial ripple effects of earning more. 7. The debate, is it fair? The fairness of progressive taxation is a hot topic. Proponents argue that it's a necessary tool for reducing income inequality and ensuring everyone contributes their fair share. After all, the wealthiest 1% often benefit the most from economic growth. On the other hand, critics argue that the wealthy already pay the majority of taxes and that progressive taxation can discourage people from striving to earn more. Middle-class earners often feel caught in the middle. They don't have access to the same tax-saving strategies as the wealthy, but they still face higher rates as their income grows. 8. How to keep more of your money. If bigger dollars mean bigger taxes, what can you do to hold on to more of your hard-earned cash? Here are some strategies. 1. Maximize tax-advantaged accounts. Contribute to 401ks, IRAs, or HSAs to lower your taxable income. 2. Invest for the long term. Take advantage of lower tax rates on long-term capital gains. 3. Plan charitable giving. Donations to qualified charities can reduce your tax bill. 4. Work with a tax professional. A good accountant can help you navigate deductions, credits, and other strategies to minimize your tax liability. 9. The relationship between income and tax rates. The tax system is structured so that people who earn more pay a higher percentage of their income in taxes. This is why as your income increases, you see a jump in how much you owe. However, it's not just a straightforward increase, it's based on income ranges or brackets. As you earn more, portions of your income fall into higher tax brackets, leading to a higher overall tax rate. This ensures that the tax burden is shared more equally, with those who can afford to pay more contributing a larger share. It's important to understand that not all of your income is taxed at the highest rate, only the income that exceeds certain thresholds. 10. The impact of tax brackets. The U.S. tax system is divided into tax brackets, each with a corresponding tax rate. These brackets are designed so that only the income within a specific range is taxed at that rate. For example, if you earn $100,000, you wouldn't be taxed at the highest rate for all of your income. Instead, only the portion above the lower bracket rates would be taxed at the higher rates. This ensures that you're not paying excessively high taxes on your entire income. Tax brackets can make it seem like you're paying a lot more when you're in a higher income bracket, but it's important to remember that progressive taxation is a system of fairness, where only the excess earnings are taxed at higher rates. 11. How do capital gains affect taxes? Capital gains are the profits you make from selling an investment, like real estate, stocks, or bonds. If you sell an asset for more than what you paid for it, that profit is taxed as a capital gain. What makes capital gains tricky is that they're often taxed at a lower rate than ordinary income, meaning long-term investments can be taxed less than short-term gains. The tax rates depend on how long you hold the investment before selling. Generally, the longer you hold, the lower the tax rate. 12. Strategies to minimize taxes. While you can't completely avoid taxes, there are strategies to reduce your tax liability. One way is through tax-advantaged accounts like 401ks or IRAs, where your money can grow tax-deferred or tax-free. Another strategy is tax loss harvesting, which involves selling investments that have lost value to offset gains. It's a useful technique to reduce your taxable income in the year you sell. 13. The role of tax planning in high earnings. When your income increases, especially if you move into a higher tax bracket, effective tax planning becomes crucial. Planning can help you take advantage of tax breaks, deductions, and credits that lower your taxable income. This might include deferring income, contributing to retirement accounts, or investing in tax-efficient vehicles like municipal bonds. With proper tax planning, you can reduce the burden of high taxes and ensure that your money is working for you in the long run. 14. How does the tax system impact different income sources? The way different types of income are taxed varies. For instance, earned income, from a salary or wage, is taxed at a higher rate than unearned income, such as dividends or interest from investments. Additionally, passive income, such as rent from property, is often subject to different rules and rates. Understanding how each source of income is taxed can help you structure your finances more effectively and reduce your tax liability. 15. The future of taxation, progressive versus flat tax systems. There is ongoing debate over whether progressive tax systems, where the tax rate increases as income increases, or flat tax systems, where everyone pays the same tax rate, are better. Proponents of progressive taxation argue that it ensures the wealthy contribute a fair share based on their ability to pay. On the other hand, advocates of flat tax systems believe that it simplifies taxation and encourages economic growth. Understanding these models can help you anticipate changes to the tax system in the future and plan accordingly. Summing it all up, earning more means paying higher taxes, but understanding the tax system and using strategies like deductions, credits, and tax-advantaged accounts can help you reduce your tax burden. With smart planning, you can keep more of your money and minimize the impact of taxes. Stay informed and make the most of your earnings. In conclusion, bigger earnings mean bigger taxes, but with smart planning, you can minimize the impact. Stay informed, use available strategies, and keep more of your hard-earned money. If you found this helpful, like, share, and subscribe for more content. Thanks for watching.